welcome to this week's MFB News. I hope you all had an absolutely stellar week and everything is good in your world. All fine here, just trundling along really, and we have got lots to cover off with you this week. So what have we got coming up? So we're going to do our usual update on swap rates, lender pricing, lender criteria changes. We're then going to talk about the MPC decision to keep interest rates at 5% in their last meeting, and then look forward to the future in terms of where the markets think things are going to head on the back of that. Then we're going to talk about the latest data with regards to the rental market, in particular rental yields as well. And then lastly, we're going to cover off the latest on rental calculations. I did say last week I was going to make a concerted effort to keep this more mortgage related, because it is a mortgage update after all. So what we're going to be talking about is rental calculations. Why is this important? So what we found is that when interest rates started climbing a year and a half ago, because of the way that lenders do rental calculations, it's based against the amount of interest you're going to be paying. The more interest you pay, essentially the less you can borrow per pound of rental income. So obviously interest rates have started coming back down again. So really just we're going to be looking at where things are now in terms of borrowing capacity. Okay, so first up, swap rates. And I suppose really just to kind of prove the point that fixed rate mortgage pricing is a kind of projection of base rate, not a reaction to base rate decisions, and therefore just because base rates stayed the same, it doesn't mean that fixed rates are going to stay the same or go down. And I think that's really where people kind of get a little bit, there's a bit of a misnomer around this. So what we often get is people saying, I need to remortgage, but I'm going to wait for the next MPC meeting to see if rates come down first of all. And we're saying to them, well, actually, that's not really how it works. If you're looking for a fixed rate mortgage, actually what you need to be watching is swap rates rather than base rate. And swap rates, as I've told you a gazillion times before, are a prediction of what's going to happen with base rate. So in the last week, we had base rate kept at 5%, more on that in a moment. We had the inflation news that came out with no change to inflation, which is kind of broadly what the markets had factored in. So actually things are performing as expected. However, there is some kind of nervousness in the background, some kind of underlying concerns. We have the autumn statement hanging over us for another month yet. And we also have some kind of greater levels of unrest with regards to Israel. And so this in itself is probably causing a little bit of concern in the markets. The fallout of that is, despite the kind of goodish predicted news on base rate and inflation, swap rates have actually gone up in the last week on a week-on-week basis. So 2-year swap rates are 3.81. 1 month ago 4%, and 1 year ago just under 5%. So actually things are year on year and month on month down, but actually if we look week on week, they've actually gone up a little bit. Same news for 5-year swaps, so now at 3.53. 1 month ago 3.64, and 1 year ago 4.38. So same story there. Things are heading downwards, but actually week on week, and bearing in mind the news about MPC and inflation has been within the last week, actually what we've seen is swap rates float up a little bit. So really the message here is, as you know, we kind of, I know I keep banging on about it, but actually fixed rate mortgage pricing is not linked to base rate, it's linked to swap rates, and swap rates are a prediction of what's going to happen with base rate, and therefore actually the fact swaps have increased ever so slightly shows there is some kind of nervousness around kind of, not nervousness as such, but a kind of underlying maybe niggling in terms of whether we're going to see base rate come down in the way that the markets had penciled in. Now, in terms of lender pricing, having said all of that, we have seen some rates in the last week, but just keep in mind the kind of timings of these things. So the reductions in rates that we've had have happened over the last week. Swap rates have only really floated up in the last couple of days. So these things always take a while to kind of come through the system. But the good news as mortgage borrowers, and this is what you're interested in, is what's happening with fixed rate mortgages. So we've seen Zephyr home loans rate reductions of 0.2%. YBS, an interesting one, have reduced their buy-to-let and their semi-commercial rates by up to 0.15%. YBS hold a very special place in my heart. They are an incredible lender, very small, very much bespoke underwriting. So there are no computer systems. I mean, even the applications we send in are basically on paper. So quite an antiquated way of doing things, but actually it brings in that good old-fashioned way of a person looking at your applications, which can be absolutely gold dust for those of you who aren't, your situation isn't a kind of box ticking scenario. Types of stuff they do, so for residential investment properties, it has to be under a limited company. They don't do personal borrowing. If you wanted a personal loan with these guys, you'd have to go to their sister company called Mortgages. So limited company lending, they can do standard properties, larger HMOs, blocks of flats, all that kind of stuff that you'd expect from a more commercially orientated lender. Also, they're able to do things like slightly unusual structures in terms of the company ownership, and also they're able to lend to trading companies as well. And also, as I mentioned, they do semi-commercial, and actually we're definitely seeing a slight uptick in the number of people looking at semi-commercial, possibly connected to the kind of implications or benefits in terms of stamp duty when you buy semi-commercial. People probably looking at maybe development opportunities as well. And also, I think it's fair to say that in some areas of the country, actually there is becoming a bit more of a return to the high street. So some people are actually seeing an increase in demand in commercial units. Not all by any stretch of the imagination, but some places are certainly seeing a bit of a high street revival going on, which is absolutely wonderful to see. Okay, what else? So Coventry and Santander have both dropped their rates by up to 0.4%. These guys, standard lender, nothing racy. So landlords with 10 or less mortgage properties in the background, no HMOs, no multi-units, all that kind of stuff. BM, same kind of lender as Coventry and Santander. Their rates have come down by 0.2. That's really good news. We're actually, BM Solutions, just worth talking about for a moment. Their service at the moment is absolutely incredible. So if you can kind of tick the right boxes to be a borrower with BM Solutions, their pricing is phenomenal, as is their service. So actually what they're doing is a lot of desktop valuations at the moment, so there's no valuer going out to a property. It's not guaranteed that's going to happen, but it does seem to happen in a lot of their applications, which means things are just absolutely flying through. Offers are coming out in a matter of a few days in some situations. So really well done to BM Solutions there. And you've dropped your pricing down, which is great. Accord Mortgages also dropped their rates down by 0.3. They're another lender who's pricing incredibly keenly in the personal space at the moment. They keep coming up tops. Leeds rates are down by 0.2 and Foundation rates are down by 0.3%. Now, the eagle-eyed amongst you there will notice that a lot of the lenders that we've just listed are actually not lenders who would be so exposed to the capital markets. These are guys who also take savers money. So YBS is owned by the Yorkshire Building Society. So actually they're a high street institution. The Coventry, Santander, BM Solutions is part of Lloyds Banking Group. Accord Mortgages we've just talked about is part of the Yorkshire Building Society, and Leeds is a building society as well. So these guys are all taking savers money and re-lending it out to you, so they're not as exposed to the capital market. So it's quite interesting that we've seen a kind of leaning towards these types of lenders reducing rates in the last week, probably because swap rates have kind of either not moved or gone up, depending on where in the timeline of the last week you're looking at, and therefore the lenders who are more exposed to the capital markets haven't had any change in their cost of funds. So I think really, still the direction of travel is downwards. It's still relatively kind of gentle in terms of the pricing steps that lenders are making, but all still going very much in a positive direction. MPC news from last week. So for those of you who haven't delved into the detail of this, so just to recap, the MPC voted to not change base rate. It was kept at 5%, and this is really the consensus of the market. So everyone kind of, broadly speaking, had called this out. 8 of the 9 members, incidentally, voted for no change, just 1 member voting for a cut rather than an increase. Now, the MPC's decision to keep rates on hold came with what they call more hawkish guidance than expected. So most of the 8 members voting to hold rates added the following new guidance. For most members, in the absence of material developments, a gradual approach to removing policy restraints would be warranted, and that suggests a relatively high bar being set in cutting in consecutive monetary policy meetings and to reducing bank rate by more than 25 basis points at a time. So the MPC note not only greater uncertainty from recent global developments and a tentative signs of shift in the balance of risks to the downside. So essentially what they're saying is actually things are feeling slightly more, and we kind of already echoed on this in terms of what swap rates are doing, and feeling slightly less kind of comfortable. So they're going to be more cautious and exercising real kind of extreme caution when they're looking at their rate cuts. So very much it's going to be not consecutive cuts month on month. They're going to be spaced out and by no more than 25 basis points, 0.25% at a time. Now, essentially the way the markets are reacting to the decision last week is they're still expecting the MPC to bring rates down in November is the good news. On this basis, it's because of service inflation and wage growth and monitoring their forecasts. That should be enough to give the MPC the comfort that they need to bring rates down in November, and then the markets are certainly penciling in a further rate reduction in February of next year. So I think actually in terms of the way the news from last week has impacted things, actually it hasn't changed anyone's view in terms of the direction of base rate and where things are heading. Things are still very much on course for one further drop in November and then 3 rate cuts throughout the course of 2025, and that would leave base rate sitting at 4%. Now, of the many reports that I read every single week, one of the ones which I kind of put a lot of stock in actually is the Hometrack reports. I find them very good. They're very impartial. They're not an estate agent. They have no vested interest. They're simply reporting on data that they're seeing, and they released their latest rental report. So I'm just going to share with you the kind of executive numbers, this executive summary of the report, which I think just makes some really interesting reading. So first of all, rental inflation has slowed to 5.4%, which is the lowest for almost 3 years, since September 2021. Now, what this means is that actually the rate of rental growth is slowing, but rental growth is still in place. So actually rents have increased year on year by 5.4%, which is a slowdown, but still a positive figure. Now, the supply slash demand imbalance is drawing out the slowdown in rent. So essentially the reason we're not seeing rental growth slow down even quicker is because there is still an imbalance between the number of properties available versus the number of people who want to rent them, i.e. there are more people looking to rent than there is supply available for. Labour take note of this, and when you lose landlords and properties to rent, it drives up rental figures when you're looking your legislations in place. Now, the number of homes for rent is rising. So the number of properties being put on the market to rent is increasing. That's not new properties necessarily, but just properties becoming vacant and being relet. But that's still a quarter below the 2019 levels. So yes, there is a slightly larger supply of stock coming to market, but actually we're still way down on where we were pre-pandemic. And rental demand is cooling off at a higher base, but is still 2 times the pre-pandemic. So essentially what we're saying here is that, yeah, actually the number of people looking to rent is starting to really slow, but actually the numbers are still really high, twice the number that they were before the pandemic. And we always kind of try and go back to pre-pandemic, purely because you can't really compare anything with when we were in the middle of COVID, because it was just an exceptional time, and thankfully not one we're hoping to revisit anytime soon. Now, rents are slowing fastest in cities led by London, but still rising quickly in towns and rural areas. So 6 postal areas with a 10% plus rental inflation. So when we're saying rental inflation has slowed to 5.4%, this is an average, but actually there's some areas which will be slowing down quicker, but other areas that are still experiencing rental growth in excess of 10%. So as always with the UK, things can be very different depending on where the property is actually based. The report then goes on to say it takes almost 3 years for rent rises to feed across the whole market. So actually what we're saying is that when rents increase, actually it isn't that suddenly everything increases or decreases at the same pace. Actually, in terms of the kind of cycle that things go through, it's a 3-year period. And finally they wrap up the report by saying that rents are expected to rise between 3 and 4% overall in 2024, and the supply-demand imbalance to remain into 2025, supporting continued rental growth. So, in summary, I think what we can clearly see here is that there are less people looking to rent. There are more properties coming to the market, and this in turn is really slowing down the rate of rental growth. But rental growth is still very much in play, and for all the kind of reasons that we've just talked about, people are expecting it very much to continue into next year as well. Okay, and then finally just on rental calculations. So rental calculations were for a while, when things got really hairy in terms of the interest rates going sky high, the rental calculations became incredibly challenging. Probably the biggest challenge that we face as a brokerage for a long time, actually, probably the best part of a year, maybe even longer. And as I mentioned earlier, the reason for this is that when lenders are assessing the affordability of a buy-to-let mortgage, generally speaking, and there are some exceptions to this, what they're doing is they're looking at the rental income. They're saying, well, okay, your mortgage is going to cost you X amount of money. You then need to allow money on top to cover things like void periods, repairs, maintenance, ground rent, service charges, And also tax. You know, the reality is that some of us have to pay a lot of tax on our rent, so I am definitely one of those people. So actually there needs to be a surplus every month. So and then based on that, what's left, what we kind of land on is the affordability calculation. So when interest rates go higher, what this means is your mortgage costs increase, which erodes into the amount of rental income you have left over for those other bits and pieces. And so therefore the rental calculation that lenders will use when looking at affordability will become more onerous. So you can borrow less per pound of rental income than you could in a low interest rate environment. And this has had a quite damning effect on the market actually. So when we had the the mini budget, and actually ever since then, because the mortgage rates were higher, people were really struggling to be able to borrow the amount of money that they needed, either to refinance or buy a property. And this left people in some fairly sticky situations, particularly for those people, if you hadn't bought a property and you simply can't afford to buy one, I mean, it's annoying, but it's not the end of the world. But for those people who were faced with paying standard variable rates of 10, 11%, I mean, this can be actually kind of, it could destroy them, you know, financially. So they were kind of stuck potentially on really, really high rates. Now, this in itself, just to kind of touch on this momentarily, really kind of expedited the product transfer offering that lenders were bringing to the table. So pre all of this going on, not every lender had a product transfer offering. So in recognising that some borrowers were going to be essentially stuck on variable rates, a lot of lenders really expedited things and brought to the table a product transfer process, which means that most borrowers could at least switch rates with their existing lender rather than being stuck on a standard variable rate, which would have not been necessarily wonderful, but it would have softened things for them at least. So that was the good news. So where are we now? So interest rates have been coming down, and actually that has meant that the rental calculations are becoming a bit more comfortable. So in terms of the kind of numbers, and this is not a straightforward thing to explain because every single mortgage product will have a different rental calculation. So things that go into this, is it a 2-year fixed rate or a 5-year fixed rate? What is the interest rate? Some lenders will do a calculation based on the actual interest rate you're going to be paying, and some of them will do a calculation based on an assumed notional rate. There's also another part of the calculation which is really linked to, generally speaking, your tax code. So if you're a basic rate taxpayer, you may well experience a more generous rental calculation than if you're a higher rate taxpayer, because basic rate taxpayers will pay less tax on their rent, which means that there's more of the rent left over to pay the mortgage because the tax bill isn't going to be so large. And equally with limited company borrowing, you guys will have a better rental calculation because the way you're taxed on your rents is more favourable than if you're a higher rate taxpayer who owns a property personally. So it's not straightforward. And then we go into kind of things like HMOs will have a different rental calculation to standard properties. There's also something called top slicing, which is where lenders will look at your own personal income and factor that in as well. So what I'm going to give you is a kind of guide, but you know, it's by no means a kind of binary number. So I suppose the message here really is, if you want to know how much you can borrow, the best thing to do is actually just give us a ring and we'll be able to chat it through with you, because it's not an exact science actually. Okay, so getting to the numbers then. So if you are a personal borrower looking to raise money against a straightforward property and you are a higher rate taxpayer, then you can borrow up to 190 times the monthly rent. So if the rental income is £1,000 per month, the maximum borrowing that rent supports is 190,000. But most lenders actually are going to be looking at circa 150 times the rent. So 190 is really pushing the boundaries here. 150 is kind of where the market sits on average. If you're a basic rate taxpayer, these numbers change. So the very, very maximum we could get you as of 10:30 last night was 224 times your rent. So if your rent's 1,000, that supports a mortgage of up to £224,000. However, actually most lenders are sitting at about 180, so 180 times monthly rent. So as you'll see, as I mentioned earlier, because basic rate taxpayers are paying less tax on their rents, it leaves more money available to cover a mortgage, which means the lenders are able to give you more money per pound of rental income. Limited companies is an interesting one. So there's no higher rate or basic rate tax kind of calculation here. It's just the same for everybody because, you know, limited companies are just taxed in one set way. These would be up to 216 times the monthly rent. But the average calculation at the moment is 144 times monthly rent. Now, this is an interesting one because previously what we would find is that you could probably borrow more in using a limited company on the rental calculation than you could if you were borrowing personally. And I was reflecting on why things have kind of turned around, and actually the rental calculations are a bit more generous for personal borrowers. And I think the reason is the way the lenders are doing their calculations. So if you just think, when I was saying a minute ago, some lenders will do a calculation where they are using the actual interest rate you're going to be paying, and some lenders will use a sort of more notional rate. And I think what's going on here is that because a lot of lenders have moved towards using the actual interest rate you're going to be paying rather than a notional rate, and because personal borrowing rates are lower than limited company rates, this in turn is kind of skewing the numbers a little bit and making it so that actually in terms of borrowing, with the rental calculation, there isn't a huge amount of difference in things. Now, so this isn't actually normally how it looks, so this might all change again going forwards. But I think really what we can deduce here is, first of all, rental calculations are really, really complicated. There's a really good calculator on our website, actually, if you want to go and have a fiddle around. But actually, probably the best thing is to do is give us a call to discuss your finances, and we can kind of advise where you can get to in terms of your borrowing. But actually, the other key message here is that things have really, really improved. So if you were looking for a mortgage previously, and actually the rental calculations just weren't able to fit with your requirements, it could be that actually the rental calculations have now eased, and also your rents have probably increased as well. So you may find that actually, thankfully, now things are starting to fit. And that's us done for another week. They just trolley round, don't they? As always, if you have any questions, do give us a call. We'd love to have a chat. 0345 345 6788, or have a look at our website. As I mentioned, there's really good calculators on there. They're pretty reliable, actually. But because, you know, everyone's situations are different, and with broking, it does actually kind of, while you can use calculators and sourcing systems, just knowing the markets really, really well is also very, very powerful. So it is worth always having a chat with us. Have a fantastic week. I think it's going to get really cold, actually. So time to dust off your winter woolies. So I hope you don't get too chilly, and I will see you again same time next week.